Hello, everyone. Um, Welcome to our discussion of the PowerPoint slides having to do with Chapter 7, Self-Employment. This is where we start talking about some business activities and in terms of the personal return. So we'll deal with the idea that you perform a sole proprietorship, a situation where you start a business perhaps in your home or whatever, but what we will refer to as a sole proprietorship and Schedule C income has to be enough of a business that it constitutes a business, not a hobby. We talked a little bit about that and the difference between a business and a hobby in our last learning module. But this is specifically in Chapter 7 about those business activities and how that affects the personal return of the owner of the business. So that's what we're looking at. So let's get into our slides here. First, a quick review of how the cash versus accrual. This is review back in Chapter 3. This came. Now it becomes a little more important because now we're talking about business activities where there's a lot of this income that may come in a different way, and they're more likely to have an accrual method if you are in business. However, most taxpayers are still, even in a business setting, in a cash method. So some examples of what we refer to as self-employment income. It's a little broader than you might think and includes things like director's fees for board of directors, fees earned by a member of the clergy for performing marriages or things like that, guaranteed payments for a partner, and anything to income from a general partner's share of their partner. Now, we'll talk about partnerships almost at the end of the semester, but just remember that that income from that partnership is generally included in self-employment income. And then you see some other things, interesting little carve out in the earnings of a newspaper vendor over age 17. That would mean under 17 is not. So that's kind of an interesting little bow to those paper boys and girls, I guess. Those income that is not self-employment, dividends, and gains and losses on sale of property, limited partners. Notice that this is a limited partner, not a general partner. Real estate rentals. Remember, we talked about that or we will talk more about that in terms of passive income. Also, S corporations share, and we'll get to S corporations at the end of the semester as well. That is not self-employment income. All right, and then you saw the part about the newspaper carriers. So once you have established that it is a business, you're going to report on Schedule C, then these are the things that you can deduct, and certainly this is what's, it has to be a necessary and ordinary business expense is the key. And so these are the kinds of things that you might see a sole proprietor need to spend money on in order to operate the business. And that's what we're looking for, is those things that are necessary to operate the business. So a little look at a review of the Schedule C here. This is also in your textbook to review. At the top, you get some information about the business. In the middle, this is your revenue. They use the term income, but we know that in accounting terms, this is revenue. This is what you bring in. And then the next section there, as part of, you might say, the revenue section, kind of out of place, cost of goods sold, is calculated on the back side of the Schedule C if you have inventory. So that's where you calculate your beginning inventory plus your purchases minus your ending inventory equals cost of goods sold. Then all other expenses are reported in this kind of middle section here. They have some listed. If you don't find it there, it does not mean it's not deductible. It just means that you're going to have to put it as an other down there and on the back. So you make a list of those other expenses that are not, shown on the actual form. So the form is not governed that this is the only thing that can be expensed. So a couple of things that are common and may need a little more explanation. Car and truck expenses, you'll remember the option of using the standard mileage rate or actual cost method we talked about in Chapter 6 for employees. Now we're going to talk about it in terms of Schedule C and being self-employed. So instead of putting this on the Form 2106 and then onto the Schedule A, you're going to put it on Schedule C, picking whichever is the best for your client, the actual cost or standard mileage rate. Typically, standard mileage rate is much easier and actually gets you a larger deduction. All right, travel expenses for themselves and their employees. If it's reimbursable, if it's an accountable plan, you count it as travel, and you put it on these two areas. You've got a travel line, and an entertainment and meals, of course, is going to get reduced by 50%. You have those two right together on the Schedule C. If it's non-accountable reimbursement, as we discussed, as the employer, you're going to put that as wage expense because that's actually going to be reported on their W-2, or should be at least. Other expenses sometimes you might forget about. Transportation while you're away, air, bus, rail. If you had to pay extra for your bags to be handled differently, often you'll pay the concierge to hold your bags while you go do business or something like that. If you had to do dry cleaning while, say, you got there and found that you had a spot on the suit you needed for a meeting and had to have that dry cleaned quickly, that would be a possible deduction. Car expenses while you're renting there, if you had to pay extra for telephone, and if you're giving tips for those who are assisting you on your travels. Same rules about combining business and personal as we saw earlier. Same rules about foreign travel, more specific, more particular about foreign travel than domestic. Again, you don't have to allocate if it is primarily for business. Education for the employee and the owner, deductible on Schedule C, as long as they don't do those two things, and assuming that they maintain or improve skills and are required by law. Same standards as we found before. Notice that tuition, books, transportation, meals, if you have to travel out of town to do that education, not because you had lunch while you were taking a course at the local college or something like that. So that's for when you have to travel out of town for education. All right, one that we haven't seen before: business gifts. Deductible cost of business gifts made to customers and clients. You'll often get a calendar, or you'll get some other small thing that's supposed to help you remember to use that business next time you need that service. There's deduction allowed for that, but that is limited. $25 is the official limit per person or per individual per tax year. Kind of referred to as the turkey rule, because the idea was that it was enough to give each of your clients a turkey for Christmas, but not much more than that, right? And in fact, today probably wouldn't get you a turkey. So, and they haven't changed that $25 limit for years, so that makes it even harder for this to be utilized and such. Now, if you give out pens, that doesn't count towards your $25 limit. That's an item $4 or less, which has your name on it. anything that you need for displaying it, signs and display racks, they don't count. And if you have your stuff engraved, then that's, or packaged, that's not going to count towards $25. So there's some kind of ways around it, but this is supposed to be pretty limiting, and believe me, you have to be sometimes creative to figure out how you're going to do that for 20. Give something to your clients for $25 or less. Business bad debts. Okay, for it to be business bad debt, it has to be that in the course of business or to generate business, you made the loan. That means that anything, if it's accounts receivable, if someone you sold something to owes you money and you have to go without collecting that, that's a business bad debt, assuming that you are on the accrual basis. You have to use a direct write-off method, no allowance method that we learned in accounting, no estimated expenses whatsoever in the tax law. So you have to actually be giving up on collecting the money from this situation. If you are cash basis, you are not going to have accounts receivable, first of all, because you don't record anything until you receive it. And if you receive it, then obviously it can't be a bad debt. So cash basis taxpayers almost never have bad debts unless they make a specific loan to a customer or somebody in order to generate business. So business bad debts are pretty rare if the business is cash basis. And I'll tell you that you will get that question over and over again in real life. They'll say, okay, we didn't collect on this service, and so we should write off this bad debt. And you'll say, well, but we never included that income in income at all because you're a cash basis. We wouldn't have included it in income until you collected it anyway. So the bad debt is the fact that you recorded revenue for something you sold to someone and then later didn't collect. So you get to match that bad debt expense against the sale. But if there's no sale, then you can't do that. So that's an important distinction and understanding that I promise you will come up in real life all the time. All right, the other thing that I really want to emphasize is a home office deduction. This is an important set of rules and issues on the Schedule C. Notice that the official rule is it means regularly and exclusively. Now, we're going to be really honest. In real life, nobody uses any room exclusively for anything. So what we're talking about, though, is if it's used most of the time, almost all the time, and regularly to do your work, okay, then it can qualify as a home office. It doesn't even have to be a specific room. It can be a corner of a room or something, but it has to fit this category. If you meet with patients or clients, it makes it really clear. This is the same rules we've come across before, except this isn't about being the convenience of the employer, because this isn't about being an employee. It's about having your own business located in your house. You have to show that either it's more important than work you do elsewhere, or you don't have an office somewhere else. That's the other key thing. No other location. This went all the way to the Supreme Court, and the court ruled that, or actually the Congress passed the rule based on making sure that it qualifies if you do administrative or management activities. That means if you're sending out bills, if you have to have an office in order to run the business, maybe you don't meet clients there, but you have to actually run the business there, then, and you don't have any other place to do that, that's when you get a home office deduction, okay? So you can either use the actual method, which is recommended and is going to give you a bigger expense, or a safe harbor method, which makes your life really simple. Actual method, you figure out what percentage of your home you use for business. Any direct expense, like a second phone line, don't have to be allocated, but everything else is going to get allocated based on square footage. Okay, so we're going to look at the Form 8829 because the 2106 was last chapter. So you start with the top. This is where you figure out what percentage of your home is used. If you are a licensed child care provider, you don't have to use things regularly, but you have to adjust for the time you use it. So if you have kids there 8 hours a day, you have to figure out how many hours out of the total hours available for the year you used a room. You do not have that option with other business because the assumption is you exclusively used it. So you don't do that with anything other than child care. All right. These are where you put all the expenses. Notice it's in this column. This is where the indirect costs that you're going to allocate between the business use, direct costs, if you had a second phone line just for the office, or you had a way to meter just the office electric, then you can put it here. But otherwise, you're going to use this column for all the expenses. Notice there's things that are not normally expended or deducted, like insurance on your home and things like that, that can be if there's a home office. Depreciation down here, we haven't covered depreciation till next chapter, so it'll be a little bit of a mystery, but for the most part we'll just give it to you, and the calculations here, it goes up here to be added to the other expense. It's always the last expense added in. You calculate this based on the income you make on the business. You cannot have home office deductions that exceed the amount of income for the business you operate. So you can't have a loss. All right. You can use a safe harbor method if that seems way too complicated. You just multiply $5 times the number of square feet up to 1,500. That's done right on the Schedule C. You don't even have to file a Form 8829. So you can see how much easier that is.